10 o'clock. Okay, so I hope everyone had a good Thanksgiving break. We're going to continue on today with Chapter 11. The last time we were together, let me just mark one more person in here. Let's get Stephen in here. Okay. So the last time we were together, we covered learning outcomes 1 and 2. So we learned about the corporate structure, we learned about some stock terminology and stock issuance transactions. So we did these two problems together using the Chapter 11 worksheet. So if you did not attend on Wednesday, you can watch the Zoom recording. It's in the Zoom recordings folder, which is in the Chapter 11 folder in Blackboard. The other thing you can do, if you prefer to break it up into smaller pieces, is you can watch the mini lectures for learning outcome 11-1 and 11-2. I think we went through part 1 of 11-2. Today we're going to do part 2 of 11-2, the mini lecture. If you want to watch that just for a review of what we're doing today, we're going to be talking about Treasury stock and Treasury stock transactions. We're going to be doing exercise E11-8 together. Then we're going to be going into 11-3, and we're going to be talking about cash dividends. And we're going to be using the worksheet and, of course, our Chapter 11 notes. So what you should probably do is start working on your homework for Chapter 11. I'd like you to see a different problem. In mini lecture 11-3, they also demonstrate a different problem, or I should say I demonstrate a different problem than that when I created that for you. I did M11-8. I want to do a different one in class, so you have the opportunity of seeing two different problems if you like. And then please continue with the concept overview videos for Chapter 11 and the Chapter 11 homework problems. They're going to be due a week from today, Monday, December 7th at 10 a.m., and the test will be due that night. Okie doke, and that's about it. So let's take a look at Treasury stock. So we left off last class talking about the issuance of stock. I can't recall whether we talked about stock exchange between investors. Let me put my chair here. So let's just, if we didn't, let's just backtrack a little bit because I can't remember, to tell you the truth. So once a company issues stock to the public and it's in their hands, then any buying and selling of that stock is between investors, and the corporation does not get involved other than to keep track of who owns it. So let's go back to this issuance here. NB issues 100,000 shares of no par common stock. So let's say that stock was issued to George Jones, okay? And George, after a while, decides, I don't want to own this stock anymore. Well, he can sell it to another investor. The company does not do reporting of any type of journal entries like this because that stock has already been issued and they've collected their money. Now it's between the two investors, the buyer and the seller, George Jones and whoever he sells it to, Mary Smith. And the company does not get involved other than to keep track of who owns it because you have to know who to send the dividend check to. Now let's talk about stock used to compensate employees. And this is not usually used for hourly wage workers. This is used for people who are higher up in the corporation. We want to encourage employees to follow what the corporation, their goals and objectives, because the corporation believes that, people run it, believe that by following the objectives and goals of the corporation, the company will be successful and the stock price will increase. So what they do is they offer them a little bit of a sweetener by giving them stock options. It's part of their pay package. So higher up in the corporation, employees' pay packages include a combination of base pay, cash bonuses, and stock options. Stock options gives the employees the option of acquiring or buying the company's stock at a predetermined price, which is often equal to the current market price. So you might think, well, who cares if you just go out in the market and buy it at the current market price? Well, that's true. That's not how the option is designed. If the employees work hard and meet the corporation's goals, the company's stock price will increase. And the employees can then exercise the option, which means buy it at that lower predetermined and then they can either hold it or they can sell it and make a profit on it. So the use of stock options is designed to encourage employees to follow corporate goals and objectives, to yield a successful operations, and then an increase in stock value. Any questions on those issues? I can't remember when we treated them last Wednesday, so I thought we'd go back a bit. Okay, so repurchase of stock. We learned that treasury stock is when a company buys back its own stock. Now, what we do is when we buy that stock, we debit this account called treasury stock. We create an account called treasury stock. It's a contra stockholders' equity account. It's got a normal debit balance. Let me show you back here. We looked at this on page 511 earlier in the last class. We said that when a company buys back its own stock as treasury stock, we don't go into the issued stock here and reduce it. We don't reduce the issued shares and these amounts, which is the par value times the number of issued shares. We don't reduce any additional paid-in capital because this is just a temporary thing. When we're talking about treasury stock, we plan to resell this. This is a temporary situation where we buy back our own stock. We're eventually going to resell it. So when we buy it back, instead of reducing this contributed capital area, we just show it as a subtraction here at the bottom. So those 4 million shares, they're up there. In the issued 50.6 million shares. We're just subtracting them out because we bought them back temporarily. We're going to reissue them. So treasury stock is an account. It's got a normal debit balance. And, it's subtracted in determining the total ownership that the stockholders have, the total equity. So why would a company buy back its own stock? Well, they might buy it back to send a signal to investors that the company believes its own stock is worth reacquiring. So less supply on the market, more demand. You might obtain shares to be reissued as payment for purchase of other companies. So when a company buys or acquires another company, it calls in, depending on the extent of the ownership, if it's a good percentage of the purchased company that is being bought, let's say 70%, I'll just pull a number up. Then the buying company calls in the shares of the company that's being purchased, and they give them the buying company shares instead. We're going to talk about a situation with Berkshire Hathaway when they bought BNSF Santa Fe Railroad. That's what they did. They called in BNSF shares, and they issued Berkshire Hathaway shares. Well, you need shares to do that, so you might have to buy them back on the market. You might be buying back your shares to reissue employees as part of the stock purchase plan that you've offered them. And sometimes employees can purchase stock at an amount or selling price less than the market share or market price. And the last one is to reduce the number of outstanding shares. Now, how does this work? We're going to learn this ratio in a few days. Let's see if I can pull it forward here. It's called the earnings per share ratio. And what it basically tells you is how much net income per share of common stock. So we take the net income and we subtract out the preferred stock dividends, and you're left with the net income that's available for dividends to common stockholders. And then we divide by the average number of common stock shares that are outstanding in the hands of the stockholders. Well, if we can lower this denominator, the bottom part of the fraction, then the earnings per share increases. And this number, the EPS number, is reported on the face of the income statement right below the net income, so investors watch this number. Now, is that manipulation to buy back your own shares just to increase the earnings per share? Yes, it is. But people who invest in stocks should know this. They should take a financial accounting class to make sure that they're aware that that number can be manipulated. Now, you're supposed to use the average. So if you buy back the number of shares outstanding, you can't do it on the last day and expect to see any real significant change in EPS because it's averaged out. But yeah, it can be manipulated by reducing the number of outstanding shares. You can increase the earnings per share. So there's a variety of reasons why a company might buy back its own stock. So here's how we record it. This is called the cost method. We take the number of shares that we're buying back and multiply it by what we paid to buy it back. In this case, we're buying, NB is buying 50,000 shares of its own stock at $25 a share, and they're going to hold them in the Treasury. So we're going to multiply these two, 50,000 times 25. We're going to debit Treasury stock for 1,250,000. Now again, normally Treasury, all the stock accounts have credit balances because they're on the right side of the accounting equation, so they have right side balances. But this account is a contra stockholders' equity account. It's subtracted. Why? Because you're reducing stockholders' equity when you give them their money back and buy back their shares of stock. Now, when you reissue that stock, when you decide to sell some of it back out to the market, you multiply the number of shares times how much you're selling it for, and that will be your debit to cash. That's how much cash you're getting. The number of shares times what you're selling it for, that will determine your cash. But you credit Treasury stock at what you originally paid for it when you bought it, 5,000 shares at 25, and you credit the Treasury stock account. You're reducing that account by doing that. And then anything extra, it would be the difference, $3 times 5,000 shares, 15,000. Or you could just subtract to get that number. That goes into additional paid-in capital. You can't make revenue on the sale of your own stock. This does not go on the income statement. This goes on the balance sheet in the stockholders' equity section, additional paid-in capital. Additional money that the stockholders have given you. It gives them additional equity. Okay, so now that example is reselling Treasury stock at a price above what you paid for it. What if you resell it at a price below what you paid for it? Well, this is what we would do. We would take the number of shares times what you sold it for, because that's the only way we can determine cash, right? The number of shares times the selling price. 5,000 times 23, that gives you 115,000. You always credit Treasury stock at what you originally paid, 5,000 shares times 25. This time we will debit to reduce additional paid-in capital. Now we can only do that because we put money in that account already here. What if you didn't have any additional paid-in capital? Then you would use retained earnings. Or if you did not have enough additional paid-in capital, maybe you only had 5,000 in that account, then you debit the other 5,000 to reduce retained earnings. You're not going to have any examples of that, but I just thought I'd mention that to you in case you wondered. Any questions so far? Okay, now let's take a look at our worksheet. In this case, we are doing the same problem that is featured in the mini lecture. By the way, I wanted to mention, last time we did this problem, M11-3 and 11-2. This 11-2 is not demonstrated in the mini lecture, but 11-6 is. So if you wanted to watch the mini lecture for learning outcome 11-2, part 1, you'll see this problem demonstrated. So we're going to go to the bottom of page 2 of the worksheet. There. And we're going to do this treasury stock problem. Okay, following selected transactions occurred for Quantum Corporation. Quantum Corporation purchased 400 shares of the company's own stock. They're buying their stock back at $20 a share. The stock is now held in the Treasury. So let's put the date down, February 1st. And what are we receiving? Treasury stock. And what are we giving? Cash. We're buying back our own stock. We take the number of shares times what we pay per share, 400 times 20, and that's a debit of 8,000 to Treasury stock and a credit of 8,000 to cash. By doing this, we are reducing stockholders' equity and we are reducing the asset cash. The reason why we're reducing stockholders' equity here is because we are debiting, and debiting is how we reduce stockholders' equity type account. Stockholders' equity is on the right side of the accounting equation, so we normally right side of credit to increase, but we're debiting to decrease. And the reason we're debiting is we're giving stockholders their money back and saying, give us back our stock. So we're reducing stockholders' equity. This is a contra stockholders' equity account. Okay, so how about July 15th? On July 15th, Corner Corporation reissued 100 of those 400 shares that they bought on February 1st. If they're selling it for $30 a share, so they just made an additional $10 in equity. Remember, it can't be a gain. It has to be additional equity. So let's find out how much cash we're going to receive. Multiply 100 shares times $30 a share. We're going to get $3,000. That will be an increase to the asset cash. What are we giving? We're giving Treasury stock. We're reselling that stock that we had bought back. And that's going to be 100 shares at what we originally paid for it, $20 a share, or $2,000. And by doing that, you're going to increase stockholders' equity because they're giving you your money and you're giving them stock. Now remember, total debits have to equal total credits, right? So the difference between those two, 1,000, or you could say the difference between 30 and 20 is $10 times 100 shares, that's also 1,000. That goes into a stockholders' equity account called additional paid-in capital. This is, again, a stock account in the contributed capital section of the balance sheet, the stockholders' equity section of the balance sheet. So equity is going to increase $3,000 through this transaction. Is everybody okay so far? Any questions? Okay. Next one. September 1st, issued 60 more of the shares purchased back here on February 1st, but this time you're selling it below what you paid for it. Well, we can only debit cash for the number of shares times the selling price. So that's what we're receiving, a debit to cash for 60 times 15, that's $900. I'm going to skip a line here, okay? And we're going to credit Treasury stock for the number of shares, 60 times what you originally paid for it. When you deal with Treasury stock, you always have to go back to the original amount that you paid for it when you are reissuing it. And that's $1,200. Okay, so there's a $300 difference. Find the difference, put it on the smaller side. Now debits equal credits. The other way you could do it is find the difference between what you're selling it for and what you bought it for. That's $5 times 60 shares. It's also $300. We're going to debit additional paid-in capital. So you can use that account in either direction. But the only time you can debit it is if you have money already in that account. You can use it up until it goes to zero. But then if you need to debit more, you need to debit retained earnings. So this transaction will increase the asset cash. It's going to decrease stockholders' equity for the amount you're debiting additional paid-in capital. And it's going to increase stockholders' equity for the amount that you're reselling on the Treasury stock. You're giving the stock back to the investors. So the net effect on stockholders' equity is an increase of 900 between the minus 300 and plus 1200. So what do you think? Any questions on it? You'll notice that each of these topics in this chapter, they're not difficult. There's just lots and lots of little topics. See if there's any, yeah, they do have some questions. they popped up on the next page. So with regard to this question, they also asked us, what impact does the purchase of Treasury stock have on dividends paid? Well, remember, only outstanding shares receive dividends, right? So if you buy back your Treasury stock, they are no longer outstanding. Or if you buy back your own stock, they are no longer outstanding. Treasury stock does not get dividends. Only stock that's in the hands of the stockholders, outstanding shares. So issued shares minus Treasury gives you outstanding shares. So buying Treasury stock reduces, bad writing, the number of outstanding shares and consequently the total dividend paid. I abbreviated the word dividend. So it reduces the total dividend paid because you've got less shares in the hands of the stockholders. They also ask us, what impact does the reissuance of Treasury stock for an amount higher than the purchase price have on net income? Well, that's the situation here. When you sell your Treasury stock for more than you paid for it, you bought it for 20 and you're selling it for 30, you're not crediting a revenue or a gain. You're crediting the stockholder's equity account. You're increasing the stockholder's ownership or equity in the company. So there is no impact on net income. There's none. Everybody okay? Questions? Okay. This next problem is the demo is on Blackboard. I'll just put on BB. This one's demonstrated on Blackboard. So if you want to see another example of Treasury stock, first issuing stock and buying it back and reselling it, you can take a look at Blackboard because that's demonstrated there in a little screencast YouTube video. No questions? Okay. Now let's take a look at the next topic in our notes. And that is dividends. Dividends are always fun to talk about. Okay, so let's talk about cash dividends. We're going to talk about preferred stock dividends later, but in this learning outcome, we're going to talk about cash dividends, stock dividends, and stock splits. We may not get to all those today, but we'll see how far we can go. Okay, so people buy stock for a variety of reasons. They expect a return on their investment, but the return can come two ways. Growth. They can decide, I want to invest for growth purposes. I don't care about dividends. I want the stock price to increase. And that way, when I sell it, I'll make money on the sale of that stock. Then there are those who want those dividends checks. They want to invest in stock that consistently pays dividends, maybe every quarter or at least every year. So there's two ways that investment can be returned, or the return on the investment may occur. So let's talk first about cash dividends. In order to have a cash dividend, in order to declare a cash dividend, you need two things in the company. Remember, a dividend is a share of the net income or earnings. So in order to share your earnings, you have to have them. You have to have retained earnings. You have to have a net income. Now, it doesn't have to be from this period. It could be a balance in the retained earnings account, net income from prior periods, but you have to have a balance in that account. Remember, earnings is another name for net income or profit, and the retained earnings account is where we keep our profit or net income. The other thing is, if you want a cash dividend, you have to have cash. Okay, so a company's board of directors considers not only possible tax law changes, but these two things. They need to make sure they have earnings to share, and they need to make sure they have cash. If they've got both, they can declare a dividend. You can't force a company to give you a dividend, even though they might have lots of retained earnings and lots of cash, a board of directors cannot be forced to do so. If you want a dividend and your company is not giving you one, then you might have to sell that stock and buy a stock that does give regular dividends. Or you can elect a new board of directors that are more favorable for issuing dividends. Okay, so 4 dates. And the last one, you already know about. Okay, so first of all, we've got the declaration date. NB's board of directors declares a 50-cent per share dividend on its 1,000 shares outstanding. Remember, only outstanding shares receive dividends. So that would be the issued shares minus what you bought back, minus Treasury shares. So on the date of declaration, this is really important, that's the day that the board of directors formally approves the dividend, and that creates the liability. Once a dividend is declared, there's no going back. The board of directors has to issue that dividend. That's the action, the declaration action that creates the liability. So we would take the per share dividend and multiply by the shares outstanding, and we would debit that dividend account. And we would credit dividends payable. We're not paying it out immediately. Debit dividends, credit dividends payable. The day of record is the cutoff date for determining who is going to get that dividend, who's going to be paid the dividend. And it usually comes after the declaration date. We're going to read an example of a declaration of dividend in a moment, so you'll see how that works out. On this date, my favorite part, no journal entry is recorded. There's nothing to record. This just determines who's going to get the dividend. And then the day of payment is when this payable is paid. And just like when you pay off any payable, you debit payable and credit cash. The last date affecting dividends is something you already know. Back in Chapter 4, we learned about closing entries. And we said at the end of the year, when the year is over, we have to zero out the temporary accounts to keep track of information for just 1 year at a time. And that was revenues, expenses, and dividends. Dividends have a normal debit balance, so to close them out or zero them out, we credit that dividends account and we debit retained earnings. Because the retained earnings account keeps in it the accumulated net income less any net income that was given away, less the dividends. So dividends always reduce retained earnings. Any questions? Okay, we're going to do another problem. And I'm going to show you the one that you will see if you look at the mini lecture on its learning outcome LO, mini lecture for LO 2-2 part 2. So you can see this demonstrated on the mini lecture, and it says it right in the title of the mini lecture, that you're going to see the demonstration of this problem. So instead of doing this one, I thought I'd do a different one so you can see 2 examples if you'd like. But it's not required that you watch that one, but if you want, just to give you a little bit of another idea of how dividends are handled. I like this one because, this should say Stanley, yes. It's like the S got cut off there. It gives you an actual announcement of the dividend. So Stanley Black & Decker is a leading global manufacturer and marketer of power tools, hardware, and home improvement products. The press release contained the following announcement. So this was October 20th, 2016. Stanley Black & Decker announced today that its board of directors approved a regular 4th quarter cash dividend of 58 cents per common share. That means for each common share. This extends the company's record for the longest consecutive, that means one after another, annual and quarterly dividend payments among industrial companies listed on the New York Stock Exchange. The dividend is payable on Tuesday, December 20th, 2016 to shareholders of record at the close of business day, Friday, December 2nd, 2016. So those are our 3 dates. So October 16th, that's our declaration date. That's the day the board of directors of Stanley Black & Decker said they were going to issue the dividend. And they announced today they approved the regular fourth quarter dividend. The payable date of payment. I'm going to write that backwards. Date of payment would be Tuesday, December 20th, and December 2nd is the date of record or date of record. So date of declaration, date of payment, and date or day of record. There's no journal entry on the day of record. It says at the time of the press release, they had 300 million shares authorized, right, which means permitted to sell by the corporate charter. We're not going to use that number. 145 million shares outstanding. This is the number we need to multiply by the 58 cents. And then they tell us the par value is $1.250 a share. We don't need that number either. Okay, so let's use the first date, October 20th. On that date is the day that dividend becomes a liability. We debit dividends and we credit dividend payable. And that's for the number of shares, 145 million. I couldn't get this number in my cheap calculator. I had to do 145,000 and multiply by 1,000 later on when I got the dividend, times 58 cents a share. That comes to 84,100,000. Now I'm not sure if you do this on Connect, I can't remember whether I give you this one or the M11-8 one below, but it may tell you to ignore the zeros. Oh, here we go. And enter your answers in dollars and not in millions. So what you would use 84,100 instead of as I did here. You would leave off those last 3 zeros. I don't think I signed this one. I think I signed 11-8. Okay, so on the date of declaration, you have to do that entry, which shows the liability. Now for the day of record, December 2nd, it says that you should put your no journal entry required. Now in the real world, we wouldn't do that. We're just proving to Connect that we know we're not supposed to do a journal entry on that day. On that day, we just make a list of who's going to get the dividend. Okay, so on the day of record, no journal entry is required. Then on the day of payment, which they said was Tuesday, December 20th, we're going to debit that dividends payable because we're going to pay it now. So we want to reduce the payable by debiting. And we credit cash. We write the checks out. And this number has to match. Whatever the payable is, you're going to pay out. Now, if they didn't give you the number of shares outstanding, but they gave you the issued and the Treasury shares, you would have to remember that you take the issued shares and subtract the Treasury shares that you bought back to get the number of outstanding shares, because it's only the outstanding shares that gets the dividend. Is everybody okay with that? Questions? Okay, so that was E11-13. And as I mentioned, M11-8 is on the mini lecture for learning outcome 11-2 part 2. And it's listed right in the heading. If you want to just kind of fast forward through the video just to see this demonstrated, you can do that as well. Or you could try it on your own and then check it against the video. No questions? Okay, so we just covered cash dividends. We're going to go a little bit further today. I never know how long it's going to take me with some of these, especially in this blended format. It's different than in class. Let's talk about stock dividends. I ignore my note to myself there. I'm just going to look at my other notes to see. We'll use these. Okay. Stock dividends are when instead of distributing cash, you're distributing a corporation's stock to its stockholders on a pro rata basis at no cost. You're giving them stock instead of giving them cash. So it's exactly what it sounds like. When they say pro rata, that means it's on the basis that you are of what you already own. It's on at the same percentage. So if you own 5% of NB shares, you're going to get 5% of the stock dividend shares. Well, here's an example. Mrs. Walker owns 100 shares of Disney common stock. Disney announces a 10% dividend. So 10% times 100 is an additional 10 shares. Mrs. Walker would receive an additional 10 shares of stock at no cost to her. Now she's got 110 shares instead of just 100. So why would a company give a stock dividend? Believe it or not, to lower the market price per share of stock. Now, why would a company want to do that? Well, because if you issue a large dividend, more than 25%, says here is a large dividend, what happens is it tends to depress the market value or the market price of the stock. And if that happens, it may make the stock more affordable. So if your stock trading volume has dropped because the market price has become so high that people can't afford to buy it, then you might want to decrease the market price of your stock so it's more affordable and increase the volume of shares traded. There are companies who don't end up on the S&P 500 because they haven't reached that magic number for trading volume. So to get on there, we're going to learn about Berkshire Hathaway in a moment, how they reduce the market value of their stock for a different purpose or for a different reason. But doing so, it allowed them to be part of the Standard & Poor's 500. Okay, so it tells us here, the stock price per share will fall proportionately. Now, that doesn't necessarily mean it will be penny for penny because this is based on buying and selling a stock. So there could be other influences that, other factors affecting the stock share price. But here's an example. 20 shares of stock, 100 per share become 40 shares at $50 a share after 100% dividend. That's an estimated amount, what we think will happen based on a large dividend. It's not definitively what will happen. Definitively, yes, it will lower, but we don't know exactly how much. We're just saying that's what we're hoping, based on 100% stock dividend. If you double the number of shares, if Mrs. Walker owns 100 shares, it's 100% dividend, she's going to get another 100 shares. So it will probably drop the market price in half. Can't tell exactly, but it should depress it to that value. How about number 2? You might want to give stock because you don't have the cash. You want to conserve cash during difficult times. Maybe you don't have it or you want to save it during difficult times. But you want to demonstrate to the stockholders that they're important and you know that you need to give them some type of return. So you give them stock instead of cash. And you might want to also signal an expectation of future earnings that your stock is worth having. Stock dividends reduce retained earnings. And you wouldn't issue a stock dividend if you didn't anticipate that you'll have future earnings to replace those dividends you just gave out. Okay, so how do we account for stock dividends? Well, it depends on the size of the dividend. Stock dividends are recorded by transferring money out of the retained earnings account, because we're sharing our earnings, into the contributed capital type accounts, into the stock type accounts. So out of retained earnings up into the stock area. Well, if you remember, that's all part of stockholders' equity. What we're going to do is take money out of here and put it up into this section. we're transferring out of retained earnings and into the stock section. So the total stockholders' equity does not change for a stock dividend. It stays the same, moving money from one section to another. If it's a large dividend, which is more than 25% of the outstanding shares, that dividend is recorded at par value. So the decrease in retained earnings equals the increase in common stock account. This would be like the journal entry that you would do. You don't have to, you're not going to be required to know this journal entry, but just to show you, we're going to be taking out of retained earnings, so debit retained earnings, and add it to common stock. So we're increasing the number of shares and the total amount in the common stock account. That's for a large dividend. So that's why stock dividends don't change stockholders' equity. You're moving money from one part of stockholders' equity to another part of stockholders' equity. Now, if it's the small stock dividend, it's still true that stock dividends do not change total stockholders' equity, but instead of debiting retained earnings at the par value, you would debit retained earnings at the market value, and then you would put the par value in the common stock account and anything over par in the additional paid-in capital section. Now, what are stock splits? Stock splits, they are not dividends. You're not issuing new shares. What we're doing is we're calling in all the old shares and then issuing brand new shares that give an equal increase in the number of shares and decrease in the par value. Let me just get a sheet of scrap paper here so I can show you. Okay, so let's see, page 519. I'm going to pull that up too. Here we go. We're going to look at this one, but I'm going to give you some more examples here of this. There. Okay. So here's the stockholders' equity section. I'm going to cover that up for just a moment. So before the stock split, this company had 1 million shares and a par value of a penny a share. So the amount in their common stock account would be just the par value, right? You can't put any more in the common stock account other than the par value. The number of issued shares times the par value per share. And the additional paid-in capital was 30,000. Retained earnings 650. Total stockholders 690. If you had a 2-for-1 split, what you do is take the number of shares multiplied by the 2 and get 2 million. Then you take the par value and divide by 2 and you get, half a penny, half of 1 cent. But notice when you multiply that out, the common stock account balance stays the same. So does the additional paid-in capital, so does the retained earnings, so does the total. In other words, the stock accounts do not at all change. What changes is the stock certificates, because you're asking stockholders to send in their old shares, although nowadays everything is electronic, you don't have to ask them to mail it in, and you're issuing new shares. So if they previously owned 1 share, now they own 2, half a par value each. If they own 4 shares, now they own 8. You're doubling the number of shares, and you're halving the par value. That's if it's a 2-for-1 split. Let's use another example here. Let's say the before situation is 10,000 shares times a $10 par value gives you $100,000 in common stock. Okay, that gives you total common stock at par value. And so if it's a 2-for-1, take the 10,000, multiply by 2, you have 20,000 shares. Take the 10, divide by 2. When you multiply it out, it still comes to 100,000 in common stock. Right. What if we have a 4-for-1? Then 10,000 times 4 would would be 40,000. $10 divided by 4, $2.50 each, still comes 100,000. A 5 for 1, 10,000 times 5 is 50. $10 divided by 5 is 2. So the total amount in your common stock account, dollar-wise, these are dollars, that doesn't change. So no journal entry is required for stock splits. Now, how different are they than stock dividends? Well, let's take a look here. If we had a 100% stock dividend, instead of 1 million shares, you're going to have now 2 million, right? Because you're going to issue a 5% of ownership, 100% of the existing outstanding shares. The par value does not change. So the common stock account, this is why you need a journal entry. You're taking 10,000 out of retained earnings. It goes from 650 to 640, and you're putting that amount up into common stock. The journal entry there would be to debit retained earnings and credit common stock. Now, the way we get that amount is we take, the number of new shares times it was 10. And that's how we get $10,000. So we would debit retained earnings and credit common stock for the number of new shares that we're issuing, 100% of the existing shares. 100% of a million is another million. We multiply it by the par value, 10,000. We're going to take it out of retained earnings and put it into common stock. That's the large stock dividend. Take it out of there, goes down to 640, add it up to common stock. There we go. The total does not change. But what changes in stock dividends is we're reducing retained earnings and putting it into common stock. Now, if this were cash dividend, doesn't change the stock accounts at all. What it changes is retained earnings. When you issue a stock dividend, you debit retained earnings, or debit dividends, which is later close to retained earnings, and you credit cash eventually after you pay it. So those, I like this comparison. This is on page 519 in our textbook. Okay, so we are going to call it quits for the day. What we did today is we went over treasury stock transactions. We did 11-8. We then went over cash dividends. We did 11-13. And actually, we did this part of earning outcome 11-3. We did stock dividends and stock splits. We're going to start Wednesday with going right into that problem and then learning about preferred stocks. So please, if you have not yet, start your Chapter 11 concept overview videos and your Chapter 11 homework. If you came in after I did attendance, please retain for a moment so I can make sure I get you listed here. Let's see. I think actually, oh, now I got to get Nick Becker in there. And I think that's it. Yep, we are all set. So I have you have a great rest of the day.
Have a good day.
Thank you.
Thank you as well.
Thank you. You too.